Discounted cash flow. Cash flow is king when you look at a company. Forget profits, throw them out of the window. If a company is making profits, that's cool, that's great, that's fantastic. But can a company continuously bring in cash? Can you cash flow more money? A PE ratio, that's going to determine whether a stock is a growth stock or a value stock. This does not determine whether or not a stock is going to go up or down. All it does is simply tell you what type of stock this company is. A seasonality report. This is the success probability of your stock, the 52-week high and low. This is the highest and lowest price of your stock or ETF. And finally, financial policy. This is the biggest variable that you will use when investing. With financial policy, if you do not understand it, Federal Reserve, interest rates, inflation, these are the things that are going to impact how well your stock portfolio performs. Because if tariffs are higher, companies are going to lose more money, meaning their stock prices might be impacted negatively. And this is just a quick overview of some of this information. If you'd like to take a brief moment to screenshot it, feel free to do so. These are just basic notes that I wrote down for you guys so that you can have a clearer and more concise understanding of these metrics. The screen's acting up a little bit here, but just take your moments to take your screenshots once it clears up here. Okay, that should be enough time for you. Now, this is particularly my favorite part here, seasonality. So seasonality uses things like averages, standard deviation, and possibility percentage or probability. So what exactly is an average? What is standard deviation? What is position percentage? Now, if we look right here, this is June, for example. In June, the average performance of the S&P 500 is 1.49%, and the standard deviation is 4.3, meaning the average is 1.49, but it can go up 4.3% more than that 1.49, or it can go down past this 1.49. So take 1.49 and subtract and add this 4.3. So you add it to figure out the max potential it has based on its standard deviation, which would be 5.79. Or on the flip side of that, you would have negative 3.2, roughly, doing mental math like a genius. If you look in June, the possibility of this percentage, or the percentage of the possibility of this happening, is 82%, meaning 82% of the time this average happens. So if we look here in March is super inconsistent. Average is 0.01, possibility percentage is 55%, meaning that it's very wishy-washy. So I like to capitalize on May, June, July, November. Now, these statistics change every year, so you must keep on track with them. However, if you can understand, well, in July, it looks like I can make 3%. The maximum amount on my standard deviation that I can lose is 2.3. That means that even if my average is at its lowest based on the standard deviation, aka 3.24 minus instead of plus 2.31, I'm still going to be up roughly 0.9%. And given the fact that you are investing into something like the S&P 500, if you hold into this long term, you're most likely going to see a profitable outcome because of that initial move upwards when you first bought in. What do I mean by that? If I know in July the S&P 500 does well, would it make sense for me to buy it in the month of July or before the month of July when June is super down? I would rather buy in June, because if June's prices are way lower than I projected them to be, and I know that July historically has an 100% chance of being in the green, I would rather buy in June. It's a very simple concept when broken down, but it's the it's the patience of the investor that is their own demise, because you are so impatient, you are so imprudent that you cannot imagine waiting a month or 2 months or 3 months before entering into a $1,000, $2,000, $3,000 buy-in, while you're buying in anywhere from $10 to $30 a day. My best advice: buy $10 to $30 a day into VOO, QQQ, CLOI, short-term bonds, and a bunch of companies. And when you see opportunities like this, that is when you bet big. It is impossible for you to lose if you understand this. If you follow these rules, it is impossible for you, as long as you are consistently depositing money into your portfolio. It is very, very, very unlikely for you to be unsuccessful. Only a dummy could lose in this type of circumstance. So if you learn something, make sure to follow, subscribe, and hit the notification bell so you can keep getting information like this for free.